Very good afternoon to the viewers of today's VCM on opportunities in valuation and capital market, being hosted by Agra branch of CRC of ICI and organized by Committee for Capital Market and Investors Present of the Institute of Chartered Accountants of India. We have the hosting branch office bearers with us and very learned speaker CA Ankit Goel ji, the eminent valuation expert on the panel. We have Ashish Jain ji, Chairman Agra branch of CRC of ICI. We have Gaurav Bansal ji, Vice Chairman. We have Saurabh Saxena ji, Treasurer Agra branch. And we have Rakesh Agrawal ji and Madam Deepika Mittal ji, Secretary Agra branch of CRC of ICI. So, not taking much time, I would request CA Ashish Jain ji, Chairman Agra branch of CIRP of ICI, to offer his formal welcome address.
Thank you.
Over to Ashish ji.
Thank you, sir. Good afternoon to all present here. On behalf of Agra branch of CIRC and with the support and cooperation of Committee on Capital Market and Investor Protection of the Institute of Chartered Accountants of India, we are hosting this seminar on valuation, opportunities in valuation and capital market. I first of all like to welcome our Central Council member CA Anil Goel sir in absentia, our learned speaker CA Ankit Goel sir for his words, which will be enlightening us, who would be enlightening us on this topic. Members in my committee of Agra branch, Gaurav ji, Deepika madam, Rakesh bhai sahab, Saurabh ji, other office bearers of the committee of institute, and the coming central council members CA Jay Chhera sir and CA Pramod Kumar Boop sir, who would be joining us gradually. So considering the topic, it is actually emerged from last 2 years after February 2019, when the valuation was made mandatory for small companies as well. So this valuation has emerged as a new opportunity for members across the country, and thanks to the lockdown, in one way that members were able to learn more about valuation and were able to do these courses and understand the concept in a better way, which resulted in a lot of valuation experts. And I hope that under the enlightenment of C. Ankit Goel sir, everyone would be more would be more blessed and to understand this topic in a better way. Thanks a lot, sir. Thank you.
Thank you, Ashish Jain sir, for your warm welcome address. Now I request Gaurav Bansal ji, Vice Chairman Agra branch of CRC of ICI, to kindly introduce our learned faculty, C. Ankit Goel ji.
Thank you, sir. We are feeling privileged to have C. Ankit Goel sir as speaker in today's webinar. The words fall short to justify the presence of C. Ankit Goel. C. Ankit Goel sir holds BCom, LLB, FCA, DSA. He is a registered valuer. He is a director in AAA Capital Services Private Limited. He is a regular speaker for insolvency, valuation, and forensic audit subjects at various firms. He is the founder partner of well-known valuation firm. Regular faculties with RVOs, guest faculty for students of graduate insolvency program at IICA. He is guest faculty for session on India's IFRS guidelines at State Bank Institute of Credit and Risk Management, Gurgaon. Mr. Goel has already had about 40 GST training sessions for the ICI, bank, companies, and at various public firms. It is really an honor to have such great speaker with us. Thank you.
Thank you, Gaurav sir. Now I request Saurabh Saxena ji to kindly introduce our visionary chairman, C. Anuj Goel ji.
Thank
Saurabh ji, you are on mute. Yeah.
Okay, thank you so much, sir. On behalf of Agra branch of CIRC, I welcome C. Anuj Goel, sir. He is a Central Council member of the Institute of Chartered Accountants of India. Within his 14 years in council, 3 years in regional council, 6 years in branch, he contributed immensely in various capacities. Presently, he is the chairman of the research committee, the oldest committee of ICI, Capital Market and Investment Protection Committee of ICI. He is also the vice chairman of Corporate Laws and Corporate Governance Committee. With the exemplary academics he possesses, Degrees like CA, CS, CMA, ICWA, LLB, MCOM, DSA, DIRM. Thank you so much, sir.
Thank you, Saurabh sir, for giving a brief intro of my chairman, C. Anuj Goel, the visionary person who has taken this initiative this year that this Committee for Capital Market and Investors Protection would be reaching a new height. Let me share with you that under his able dynamic leadership as a chairman of the Committee for Capital Market and Investors Protection, the committee has recently launched two very important certificate courses. One on this fundamental and technical analysis, including equity research, and another certificate course on financial market and securities law. That this valuation part is also covered in FATA course, fundamental and technical analysis. That is also very much relevant to this today's VCM. So this is the vision of my chairman. Let me share with you my experience with him as a secretary to this committee itself. Although I have served with him in various committees, in Committee for Capital Market and Investors Protection way back in 2015 when he was the chairman, these two certificate courses were launched by the Council of was approved by the Council of ICI. Then I think it was waiting for him again. And this year he again chaired this committee. And in very first meeting, he decided that this year, before he leaving this committee, this certificate course would be live. So he is so prompt in decision making, and he is so pushy. And I think it took 6 years from coming from decision taken in the council to on ground reality. And it took only 2 months when he decided that this course is to be launched. Then it was launched by under the able leadership of Anujji, and was launched by our own fraternity member, CA Piyush Goel ji, the Honorable Union Minister, has launched these two certificate courses, and a warm welcome received, warm response received on these two certificate courses by the members. It is taken very wholehearted by the members, and I think it would be a new milestone in the history of Committee for Capital Market and Investors Protection. But it is not right that I am describing each and everything. We have the presence of Honorable Chairman, who would be the right person who can guide us, the various initiatives taken, and as well as the expectation of the member from this VCM on valuation. I think we have in the M2M, we have taken this as an opening remark, but rather it should be a keynote address, because the person who is possessed all the three qualifications like CACS, ICWA is the right person who can deliver a keynote address on any such a vast topic. So not taking much time, I should not be in between to you and Honorable Chairman. So I would request C. Anuj Goel ji for his keynote address.
Thank you, Dr. Amit Kumar Adwalji, our young and dynamic Secretary of Committee on Capital Markets and Investors Protection, as well as Research Committee. We are having the presence of C. Amit Adwalji and Sri Kunal Sharma ji, who are contributing like anything for the cause of the profession, for the cause of the members, and our very prominent resource person, C. Ankit Goel ji, our young and dynamic chartered accountant, eminent valuation expert. So on behalf of the Institute of Chartered Accountants of India, Committee on Capital Markets and Investors Protection, and very prominent Agra branch, I welcome CA Ankit Goel ji on this very important topic, opportunities in valuation in capital market. And we are having our leader of the profession from Agra, my brother, the chairman of Agra branch, CA Ashish Jain ji. A very big round of applause to CA Ashish Jain ji. Very prominent and active branch of our central region of the state of UP, the cultural capital of the world, I will say. And we are having CA Gaurav Bansal ji, our honorable vice chairman, Agra branch. And we are having a dynamic secretary of the Agra branch, Madam Deepika Mittal ji. Very big round of applause. And of course, our Dhankuber CA Saurabh Saxena ji is amongst all of us. And we are having very prominent leader of the profession from Agra, Honorable Sikasa Chairman, my brother, C. Rakesh Agrawal ji. So very big round of applause to all the leaders of the profession from Agra, and we are having more than 2,000 chartered accountants. Around 2,500 chartered accountants are live with us. So I welcome all our honorable members from each and every part of the country, rather outside country, also to this very, very important VCM on opportunities in valuation in capital market. And I am really very happy that the young chartered accountants like Ankit Goel ji is coming forward and is trying to see that how we can really do something very, very concrete in this valuation field. And there are lot number of opportunities for the chartered accountants in valuation only and only in capital market, because the valuation is very, very important in capital market. So I'm quite confident that all of us will certainly see that how the chartered accountants can play a very, very active role. And you must be very well aware that the chartered accountants who are in whole time practice, if Rakesh Agrawal ji or our honorable chairman Ashish Jain ji are in whole time practice, they can very well be the valuation professional, and in addition to be a practicing chartered accountant. Saurabh Saxena ji or Deepika Mittal ji can very well be a practicing chartered accountant, can very well be a valuation professional. So I'm quite confident that all the chartered accountants will certainly see that how we can play very, very important role in valuation, and particularly valuation in capital market. So I will urge all our honorable members to please see that how the chartered accountants can play a very, very active role in this very, very important field of capital market. I think no professional other than a member of the Institute of Chartered Accountants of India can understand the nitty-gritties of capital market better than a chartered accountant. And you do take the best of the names in the capital market. Rakesh ji, you will find that at the top the chartered accountants are there. Whether it is Rakesh Jhunjhunwala, he is supposed to be the member of the Institute of Chartered Accountants of India. Whether Rudramurthy ji, I couldn't see the video of Ashish Jain ji, so I am not able to take his name. But Ashish ji, you will see that whether it is Motilal Ostwal, whether it is Anand Rathi, Gaurav Bansal ji, our honorable vice chairman of the branch, is here, and he will appreciate that very recently we had the best of the resource persons. Yesterday we were having very, very prominent chartered accountant who is playing very, very important role in the capital market. What was his name?
Ashish. No, Murarka ji.
Murarka ji. Nitin Murarka ji, and before that Ashish Baheti ji and Rudramurthy ji, billionaire. So hardly 36, 37 years of age. Ramdev Agrawal of Motilal Ostwal Group. So the chartered accountants are at the top. They are contributing like anything in this field of the capital market. So I will urge that the chartered accountants should certainly come forward, particularly the practicing chartered accountants. Now, our Committee on Capital Markets and Investors Protection, Ankit Goel ji, we have taken a decision in the very first meeting of the Committee on Capital Markets and Investors Protection. After 72 years of the inception of the Institute of Chartered Accountants of India, we have opened the capital market for the practicing chartered accountants. Now, our practicing chartered accountants, Gaurav Bansal ji or Saurabh Saxena ji or Rakesh ji or Deepika ji, besides being in practice, can very well have income from equity derivatives. They can very well have investment in equity derivatives. They can very well have income from equity derivatives, and they can be in whole-time practice. So we are trying our level best to see that how the chartered accountants can play a very, very active role in the field of capital market. And when the chartered accountants will be there in the capital market in a very, very prominent way, I think it will serve n number of purposes. It would be very, very good for the chartered accountants, because capital market means the kripa of Lakshmi. तो लक्ष्मी की कृपा चार्टर्ड अकाउंटेंट्स पर होगी if they will be very, very active in the capital market. And the capital market, if the chartered accountants will be there, then it would be very, very good for the trade and industry. It would be very good for the corporate world, and it will be very, very good for the investors and each and every citizen of the country. So I'm quite confident that all of us will certainly ensure that how we can play a very, very active role. And if the chartered accountants will be there, the best accounting professionals across the globe in the capital market, I think we can very well reach to the 5 trillion economy target of the Prime Minister Modi. Rather, we can reach to the 10 trillion economy target of the target if the chartered accountants will be playing very active role in the capital market. Because if the capital market will be in the safe and secured hands of the members of the Institute of Chartered Accountants of India, I think the economy will be there in the strong hands. And if the capital market is strong, of course, the economy will grow by leaps and bounds. So, as rightly remarked by one of the renowned philosophers, knowledge increases by sharing, not by saving it. And Ankit Goel, I know his father, CA Anil Goel, also he is contributing in IBC, insolvency and bankruptcy. And I think how we can share the knowledge, and if we will be sharing the knowledge and not saving that knowledge, I think it will increase manifold. It would be win-win situation for the speaker also, for the resource person also, and for the receiver also, for the listener also. So I welcome once again Ankit Goel, and I'm really grateful to Agra branch for being very active and being the part of these initiatives of the Institute of Chartered Accountants of India and Committee on Capital Markets and Investors Protection. Very soon we are going to have a national conference in association with the Agra branch. 3 days national conference we are planning to have of the Committee on Capital Markets and Investors Protection only. Friends, as we were just discussing that we are already having very prominent certificate courses, certificate course on derivatives, certificate course on forex and treasury management, and we designed specifically the certificate course on derivatives and forex and treasury management for the members of ICI at Gulf countries. I think 25,000 chartered accountants are there, Deepika ji and Gaurav sir. And we have specifically designed our certificate course batch for the chartered accountants who are there in Middle East, so that we can serve not only the chartered accountants who are in our country, but also the chartered accountants who are in other parts of the world. And on 1st July 2021, on 73rd Chartered Accountants Day, Saurabh ji, we have launched these two very important certificate courses. And on 10th July itself, on Sunday, we have started the classes of these two new certificate courses, and now we are having total 4 certificate courses to sharpen the skills of the chartered accountants in the best possible manner. Friends, if we observe the last few decades, the role of chartered accountants were confined to the conventional areas relating to accounting, auditing, taxation, etc. But with the advent of globalization and growing importance witnessed by capital and financial markets in last few years, larger number of members are venturing into the area of capital markets with an aim to excel in it. Friends, I truly believe that the domain of capital market is full of professional opportunities, considering the kind of expertise possessed by chartered accountants with respect to handling numbers and finance. Friends, in a business parlance, valuation refers to the process of determining the present value of a company or an asset. It can be done using a number of techniques. Generally, the analysts or the concerned person determines value of a company based on management of the business, the prospective future earnings, the market value of the company's assets, and its capital structure, composition, etc. Friends, valuation may also be used in determining a security's fair value, which depends on the amount that a buyer is ready to pay a seller, with the assumption that both parties will enter the transaction. So there are numerous ways through which valuation of securities can be derived, such as the dividend discount model, DDM, discounted cash flow model, DCF, comparable companies analysis, etc. I think Ankit Goel is an expert. He will dwell upon all those models in the greater detail. And this shows chartered accountants can do wonders in the area of valuation in capital markets, considering the importance of the work involved and the level of knowledge and expertise possessed by the chartered accountants. Therefore, through today's VCM, our aim would be to throw some light on the topic of opportunities in valuation in the capital market and discuss its nitty-gritties, which will further aid the members to understand and acquire the professional opportunities in the capital market. I will not be taking a further time as we are very, very eager to hear our learned guest speaker, CA Ankit Goel ji, who is going to teach all of us practically on opportunities in valuation in capital market. So I once again welcome CA Ankit Goel ji on behalf of the Institute of Chartered Accountants of India, on behalf of Committee on Capital Markets and Investors Protection, and on behalf of Agra branch, one of the most prominent branch of the Institute of Chartered Accountants of India, one of the most prominent branch of the central region, and one of the most prominent branch of my state, the state of the Uttar Pradesh, and I think the cultural capital of the world. So we are having the presence of Ashish Jain ji, Chairman Agra branch, Gaurav Bansal ji, Honorable Vice Chairman Agra branch, Deepika Mittal ma'am, Honorable Secretary Agra branch, Saurabh Saxena ji, Dhan Kuber of Agra branch, and CA Rakesh Agrawal ji, our Honorable Sikasa Chairman of Agra branch. I welcome all our honorable members who are present with us from each and every part of the country, rather outside country. Around 2,500 chartered accountants are live with us. So I once again welcome all our honorable viewers on behalf of the Institute of Chartered Accountants of India, Committee on Capital Markets and Investors Protection, and all the leaders of the profession from Agra. And I welcome Dr. Amit Agrawal ji, our young and dynamic secretary of our Committee on Capital Markets and Investors Protection, CA Amit Agrawal ji, Sri Kunal Sharma ji, who are dedicating themselves for the cause of the profession, for the cause of the members. So I once again welcome all of you on behalf of the Institute of Chartered Accountants of India, on behalf of Committee on Capital Markets and Investors Protection, and on behalf of Agra branch. Thank you very much, friends.
Thank you, Chairman sir, for your guiding words and wonderful keynote address. Now, I would request session speaker, C. Ankit Goel ji, eminent valuation expert, for deliberation on the topic. Over to Ankit Goel ji.
Good afternoon, everyone. Good afternoon, all my fellow members of ICAI. Good afternoon to Anuj Goel ji, Central Council member, ICAI. Good afternoon to everyone at Agra branch of CIRC, CA Ashish Jain ji, CA Gaurav Bansal ji, CA Deepika Mittal ji, CA Saurabh Saxena ji, and CA Rakesh Agrawal ji. I will thank all of you to allow me this opportunity to learn. Sharing whatever I know, whatever anyone knows, I believe is the best way to learn. And that's what I'm here to do. I'm a student of valuation, and I think I will remain a student of valuation for life. And I'm here to share whatever I understand about valuation opportunities in capital markets for chartered accountants. As Anuj said, that our profession is a very, very dynamic profession. At one point in time, yes, we have been auditors since we all have become chartered accountants. That is the first thing that we understand. That is the basic part that we start. And yes, we have a zeal as chartered accountants to take hold of every opportunity that comes our way, whether it becomes taxation, whether it becomes compliances, whether it becomes GST. We have shown the entire nation how we have the zeal to pick up something that is new, something that is that can be worked upon, that can be gained in knowledge, and then using it for the country, using it for the welfare of the profession, and using it for the welfare of the society. And I will take an opportunity here to say that the chartered accountants have a very, very strong responsibility to uphold the capital market independence. Dr. Sahu, the chairperson of IBBI, repeatedly says, he says that markets are the best and the most innovative creation of mankind. And to safeguard these markets from those who can create some distrust in the markets for market participants is a very, very important activity that Anuj and his team are doing as part of this committee. Very, very important role to be played here. I will not take more time. I will share my presentation with all of you and start discussing on my presentation. So we will talk about opportunities in valuation for chartered accountants in capital markets. We will also talk about how this profession or this part of valuation is changing, and how this profession as chartered accountants, how we need to talk about registered valuer framework under the Companies Act 2013, as well as the proposed registered valuer framework under the Draft Valuer Bill 2020. We need to talk about it because we need to be ready about the future, the expected future, how things are going to change from the regulatory point of view, and we need to be ready for it so that we have an advantage over others who might also be wanting to step into this profession. We will talk about requirements for valuations in capital market. We will talk about various CB regulations and valuation requirements, price discovery process that is adopted in our country with respect to IPOs, with respect to new issues, working as a valuation analyst, how those of us who are not in practice, who want to have a career in valuation while in employment can discover that opportunity. Importance of compliances with standards. We will briefly talk about how the valuation standards have a very, very important piece, very, very important role in the entire process of the valuation. Then present legal framework for registered valuers. Sorry?
Actually, the thing it has been changed.
Present legal framework for registered valuers. What is the opportunity? What is the market size? What is the kind of spread of registered valuers as on date? Then how we become a registered valuers for those of us who amongst us and who want to be registered valuers. What are the steps to do that? What is the kind of valuation examination that you have to go for in brief? And of course, the draft valuer bill and the report of the committee of experts. We'll talk about all that. So going forward, we have a process. We understand that the process of valuation in capital markets is very, very important. Why is it important? It is important to safeguard the market participants. It is also important to safeguard the interest of the investors who we are representing. So the hats can change. We can do different things for different people. We can represent the company as a chartered accountant. We can be an independent valuer. We might be representing maybe a regulatory authority in trying to find out that, yes, whether the valuation report was right or not. We might be doing a peer review for a valuation report. That is a very, very important report, which is part of the IBBI review framework. We can be working for somebody in employment and trying to find out the possibility of the underpricing or overpricing of a security, and then maybe that advice that we give as a valuation analyst might have a very, very, very strong effect over the understanding about that company, that share. As always, in valuation process, we always start by understanding and gauging the actions of the company and its impact on its share price. As we all know that the share prices that we have in capital markets that are live, that are changing constantly due to the demand and supply changes, they are all a natural way for the markets to tell us that yes, this is the sentiment behind a particular share, behind a particular company, behind a particular security. And that sentiment is something that nobody has any reasons to believe that sentiment is not correct. That sentiment, of course, takes into account the possibility of future earnings. That sentiment takes into account the discount rate or the expected discount rate, expected earnings that people have from the markets. And of course, it takes care of all the uncertainties that are expected in the earnings of a particular entity in future. Many people say that, oh, COVID is here. First wave went through. All right, maybe we were very scared from the first wave, but as it passed through the country, we kind of realized that no, India is less affected due to this COVID as compared to maybe the world. But when the second wave came in, we were more affected, certainly more affected than the first wave. And we have an understanding now that yes, the first wave came, the second wave came, the capital markets are where they are. They have not gone down. The Sensex is where it is. And why do we say that? Yes, that is how it is. Because we understand that the pricing in the capital markets is all about pricing based on economic principles of price equilibrium, economic principles of anticipation of future benefits, and economic principles of substitution. Today, if today somebody says, oh, I think the market is very overheated, I want to exit, the biggest problem is that if he sells his shares, what does he invest in? If he sells his mutual funds, what does he invest in? Where does he find the kind of returns that are historically being given by the market? The second point is that yes, a majority part of the wealth, the market value or the market capitalization of a share is anticipation of future benefits. And we all understand that because we understand that the cost or the value of a going concern takes into account the idea that if you put in 100 rupees today, yes, you might be able to make that 100 rupees many more over the next few years in the form of earnings that come to you. But you might add even more than that in terms of the earning potential of the company in the long run. And what do you do to understand about the company, understand about the impact of its share price? Of course, historical analysis is what you do. You participate in quarterly interactions with the company representatives, you participate in investor roadshows, and so on. You understand the company, what are they wanting to do, what are their plans for growth, what are their plans for R&D. Okay, maybe we want to value, say, a company like Maruti Suzuki. What do? We need to understand, right? Is this not a valid question to understand that yes, what does this company think about the change in technology that perhaps is going to happen as time goes along? Maybe 10 years, 15 years down the line, maybe earlier, we may not be able to see any petrol cars or diesel cars on the road. Maybe everything becomes electric. Totally depends on how technology changes, how the perception or the acceptability of EVs is accepted by the country, and how the costs change, how the technology barriers are modified as new technologies are invented, new ways of doing the same thing are invented. Estimating value of future profits is, of course, the key part. As I said, economic principle of anticipation of benefits involves substantially that. Using relative data relevant to the industry, substantial part of how we value securities today is the PE ratio. We try to understand, what is the price? What is the earnings? What is the price to earnings of its comparables? What are the factors that make a difference between this company, my target company that I want to value, and the company that is already listed there? So if people are believing that that company that is listed already or that is already functioning, that is the other company beyond my target company, has this kind of a PE, has this kind of a earning potential, then I need to change those factors to come to the valuation for my target company. That is what I do. Pricing management, past performance and future ability, and then recognizing underpriced and overpriced stocks is the final conclusion that mostly we do for already quoted shares. Coming to SEBI regulations. SEBI has a host of regulations. I have listed a few of these, and I have tried to talk about all the regulations that mention valuations at some point in time and somewhere in the regulations. Talking about LODR regulations 2015, regulation 87A, it requires the issuer whose security receipts are listed on a stock exchange to get the listed security receipts valued at the end of each quarter by an independent valuer. And here the valuer shall have the same meaning as assigned to them under the Securities and Exchange Board of India issue and listing of securitized debt instruments and security receipts regulations. These regulations primarily point to Section 247 of Companies Act, which again points down to the registered value as recognized by IBBI. We will talk at length about how that registered values under IBBI are important. SEBI public public offer and listing of securitized debt instruments regulations 2018, regulation 38D there talks about how prior to listing of any security receipts on a recognized stock exchange, each security receipts have to be valued by an independent valuer. 38G talks about mandates an issuer whose security receipts are listed on a recognized stock exchange to ensure that a valuation is conducted by an independent valuer. And again here, the reference to the definition of valuer is Section 247 of Companies Act 2013. SEBI Infrastructure Investment Trusts, InvITs as we call them popularly, InvITs, again the valuation should be in accordance with Regulation 21, and the computation of NAV and the InvIT should be based on the valuation done by the valuer and should be disclosed to the stock exchanges not later than 15 days from the date of valuation. And registered valuers under 247 are required to undertake this valuation. REITs are real estate investment trusts. The computation of NAV and the REIT should be based again on the valuation done by valuer and should be declared not later than 15 days from the date of valuation of the stock exchange, and such computation shall be done and declared not less than once in every 6 months. Delisting of equity shares. Regulation 33 requires a recognized stock exchange to form a panel of expert valuers, and where the equity shares of a company are delisted by a recognized stock exchange under the chapter, the recognized stock exchange shall appoint an independent valuer or valuers who shall determine the fair value of delisted equity shares. Then we have issue of capital and disclosure requirement regulations 2018 talks about that the fact that where exemption from the requirement under chapter 5 is sought for the preferential issue of specified securities made to lenders pursuant to conversion of their debt. In that case, the conversion price is to be certified by two independent valuers. Then where exemption from chapter 5 of the said regulations is sought for the preferential issue of specified securities made to persons at the time of lenders selling their holding of specified structures, securities, or enforcing change in ownership in favor of such persons pursuant to a debt restructuring scheme. There again, this kind of evaluation is required. Then preferential basis for consideration other than cash. There, the valuation of the assets in consideration for which the equity shares are being issued shall be done by an independent valuer. That is again something which is required. Further, if the stock exchanges is not satisfied with the appropriateness of the valuation, it may get the valuation done from another valuer. Then there's substantial acquisition of shares and takeover regulations. So regulation 10 provides for certain exemptions from requirement to make an open offer, and it includes acquisition of shares by the person by way of allotment by the target company or purchased from the lenders at the time of lenders selling their shareholding or enforcing change in ownership in favor of such persons pursuant to debt restructuring scheme. So again, something where there is a clause which allows for an exit at a price or for banks to convert their debt restructuring schemes and get shareholding based on these regulations. Then there's a procedure for refund to investors regulations. This talks about how the administrator appointed under the said regulations shall engage the services of a registered valuer to evaluate the properties of defaulter that are attached by the recovery officer and for submission of a certified valuation report in accordance with guidelines issued by the board. We have then SEBI mutual fund regulations. These talk about the requirement under regulations 49F and 49G of the said regulations and how they require the asset management company to appoint valuers for valuing a real estate asset or real estate mutual funds. So in this case, regulation 49A talks about defining a real estate valuer, and it refers to qualified valuer of real estate assets which has been accredited by a credit rating agency registered with the board. Then there's the issue of sweat equity regulations. Now, regulation 8 requires the evaluation of intellectual property rights or of the know-how provided or other valuation mentioned in explanation 2 of section 79A of the Companies Act. and it is to be carried out by merchant banker, and the merchant banker may consult experts and valuers having regard to the nature of industry and nature of property. And then it defines regulation 2 talks about how a chartered accountant or a merchant banker can be appointed to value intellectual property rights or other valuation. Then there is alternative investment funds. Here, category 1 and category 2 alternative investment funds are required to undertake valuation of their investments at least once every 6 months by an independent valuer. Securities Exchange Board of India intermediaries, again, it talks about how the board may appoint a qualified valuer or direct a qualified valuer to be appointed by the intermediary if so necessary by the board. Then there's SEBI collective investment schemes. The advertisement for each collective investment scheme shall disclose, in addition to the investment objectives, the method and periodicity of the valuation of collective investment scheme property. So again, a reference to valuation here in the collective investment schemes. So this is the SEBI regulations that require valuation. And as you might notice that most of the requirements now refer to registered valuers under Companies Act, and a few still talk about merchant bankers as well as chartered accountants. Understanding the price discovery process for IPOs should be our next agenda. So the price band and the minimum bid lot of an initial public offer is normally decided by promoters or selling shareholders of a company in consultation with the book running lead managers. And it is advertised widely, circulated in newspapers at least 2 working days prior to the offer opening date. That is the big advertisement that we see in newspapers when we talk about a new issue coming to the public. And it talks about all the relevant financial ratios, calculated the floor price and the cap price, and are made available to the stock exchanges for uploading on their websites. Then for the announcement of the price band and the bid offer period, working days, of course, are defined here, and these are excluded. Public holidays are excluded. The price band may move up or down to the extent of 20% of the floor price and the cap price, and that can be revised accordingly, the floor price as well as cap price. And in case of revision in the price band, the offer period gets extended for at least 3 additional working days. This is the requirement under the price discovery process. Then in case of a downward revision in the price band, retail individual investors and employees who have bid at the cutoff price could either revise their bids, or the excess amount paid at the time of bidding will be unblocked for them. An IPO can typically be a fixed price issue or a book built issue, and then normally we have a big book built issue in India, and the factors impacting the price are the financial performance of the company over the last 3 years on a quarterly basis, projected growth in revenues and profit suitably ratified by channel checks, unique nature of the product and the moat of the company, and the amount of the company has been able to create, and the value addition that they have been able to create, comparative valuation of companies in similar industry groups, qualitative factors such as management pedigree, brands, and corporate governance. So these are all strong parts, strong factors that impact how market perceives the valuation or perceives the value of a share of a company. Then there's an absolute approach to IPO where it says that, okay, in case of profit-making companies, the focus is on discounting the cash flow of the future. So what does the economic principle say? Anticipation of benefits. So you kind of look at what is going to happen in future. And typically the future cash flows of the company are projected, and then an appropriate discounting of these factors is done to arrive at present value. But what about companies that are not making profits? In that case, you kind of go down and see the EBITDA, see other ways of finding the values that they might be able to contribute. And it is quite common in case of companies that have long gestation periods or where business involves higher initial outlays, such as e-commerce, pharma, and in such cases, the enterprise value is measured as a percentage of EBITDA to arrive at an indicative valuation parameter. That is what is normally done. Relative approach goes to market approach, talks about economic principle of price equilibrium. And when you talk about economic principle of price equilibrium, what do you see? You say, oh, what are the other people doing who are similar to me? Okay, so stock valuations and IPO valuations are never done in an absolute term, but in relative terms. And one example, for example, even with robust cash flows, companies dealing in commodities attract lower valuations due to cyclical nature of their business. Hence, such commodity companies attract lower valuations compared to brands. Typically, relative valuations use parameters such as PE, price to book value ratio, dividend yield, enterprise value to EBITDA ratio. And normally, once the absolute valuations are arrived at, the relative valuations are considered based on the peer group comparisons and overall market PE benchmarks. Working as a valuation analyst. So it's not important to always practice as a valuer. You can always find opportunities as a valuation analyst and analyze an asset, a business, equity, real estate, commodity, fixed income securities, etc., and estimate values for the same. And this can be done in employment with the brokerage. There is also a lot of market in India for KPO services with respect to valuation, where international companies, international mutual funds, international investment houses have made huge investments in India to tap the talent available here with respect to valuation analysis, because it's a very, very challenging task to do this. And they have kind of shifted a lot of their work to India. I know quite a few people who have done CFA, who have done other courses, and they are chartered accountants, and they're now working as valuation professionals or valuation analysts for international fund houses for their operations internationally. Coming to Companies Act, that was SEBI regulations for you. Coming to the main act, Companies Act, Section 247 talks about how valuers can be recognized, registered, and what is the duty to function to conduct the valuation exercises. Section 62(1)(c) the Companies Act, read with Rule 13(1) of the Companies Share Capital and Debentures rules, talk about how further issue of share capital, if done using a preferential allotment route or a private placement route, requires a valuation. So in this case, a mini prospectus is required almost, and that is what is approved. The whole issue is, of course, approved by the board of directors and subsequently through a special resolution of the shareholders. And only after that, the company is able to do a private placement. But during the process of sharing the information, sharing the knowledge, one of the steps involved is getting the valuation done for the company's shares at the time of issue of the offer for allotment or offer for private placement, which is given to the interested investor. Why is it required? Now, we need to understand that the basic idea behind it is to protect the investors. Protect who all? Protect the existing investors, protect the new investors. How do we protect the existing investors? We make sure that the company is not issuing shares at a value which is less than the market value of its shares. And how are we protecting the investor? We're protecting the investor by saying that, yes, as per the regulations, as per the valuation methodologies, as per the economic principles of which involve use of income, cost, and market approaches, the value of these shares is this much. And yes, we are interested in making sure that there is nobody, no investor who is hurt because he is paying more than what should have been paid for the shares. Section 177(4)(6) of Companies Act talks about how terms of reference of audit committee, and there again there is a requirement for valuation. So valuation requirement might be done because the audit committee normally then understands and appoints the process or finalizes the process of doing a fair value, doing a valuation exercise, checking in case there is no impairment in the assets. Section 230 and Section 233 of the Companies Act, they talk about how power to compromise or make arrangements with creditors and members. And of course, 232 2D and 232 3HB of the Companies Act talks about mergers and amalgamations. In all these areas, there is a very, very high opportunity available for valuers, for registered valuers. Then Section 236(2) of Companies Act 2013 discusses about the possibility of the company's major shareholders buying out the minority shareholding, and also the company buying out the minority shareholding, and so on. And this section talks about how the valuation is required for such a purchase to happen. 247, of course, talks about the entire registered value framework. It talks about how registered values would be appointed, how it is delegated, and then, of course, it has to be read with companies' registered values and valuation rules 2017. Section 281(1)(a) talks about how the report is required to be submitted by the company liquidator. Rule 2(c)(9) of the company's acceptance of deposit rules talks about how there are certain exclusions from deposits. Rule 6(1) of the company's acceptance of deposit rules talks about creation of security and the valuation of that security for the purpose of giving comfort to the investors. Rule 8, 6, 7, 9, 12 of the company's registered company's share capital and debenture rules talk about issue of sweat equity shares. Rule 16(1)(c) of the company's share capital and debenture rules talk about provision of money by company for purchase of its own shares by employees or by trust for the benefit of employees. Rule 12(c) of company's prospectus and allotment of securities talks about how the return of allotment, when it is filed and where the shares have been issued through private placement, needs to have a valuation report attached with the filing. So Section 247 of Companies Act 2013 was put in force with effect from 18th October 2017, and the rules that I just mentioned, companies' registered valuers and valuation rules, were put in force on the same date, but it came with a transition provision. So for a long time, almost up to 31st January 2019, it was allowed that valuers who were doing valuations prior to the registered value framework coming into picture would continue their work, primarily because the whole process was under transition, and the valuers who were recognized by IBBI under Section 247 of Companies Act, those valuers were adding up. They were qualifying their examination. They were becoming members of the community, valuation community, and so on. So IBBI are tasked with preparation of framework for regulation of valuers. So basically, this transition arrangement is since over. Today, registered valuers can only do the work that registered valuers were supposed to do. We will come at and we will come at the point where we understand, yes, that what are the kinds of what is the kind of framework there, and what kind of numbers do we have with respect to registered valuers. And of course, IBBI was tasked with preparation of a framework for regulation of values in India. There was a very, very well conducted interactive sessions across the country where existing registered valuers, prospective registered valuers, they all came in and talked about how they expect, what they expect the new valuer bill to be. And they gave their opinion, they gave their inputs there to IBBI led committee of experts, and that is what then was taken care of, and basically that report is out now, and that report also has a draft valuer bill attached with it. So the IBBI regime basically it provides a centralized institutional framework for development and regulation of valuation profession. Right now, different acts before this change talked about how the valuers can be punished for any wrongdoing. Many valuers who are working for banks, especially in land building asset classes, because that's where mostly valuers are engaged by banks to do that kind of valuation for the purpose of valuation of the security that the borrower is giving. And that is where most of the valuation professionals did not have a regulatory body on top of them. As chartered accountants, yes, we are governed by ICAI. They have a regulatory head over us, regulatory hand over us. But yes, the new framework talks about how IBBI can do plenty of punishments can be given, plenty of measures can be taken by IBBI to preserve the confidence that people need for having a trust in the valuation reports. So IBBI has been designated as principal regulator while multiple competing RVOs act as frontline regulators, and limited applicability to Companies Act, IBC, and few CB regulations. This is what this has been implemented on. So the Companies Act, of course, is carrying the definition of registered valuers, so it has automatically applied to the Companies Act. IBC also has the reference to the valuers is given as reference to the regulator there. An ad hoc arrangement has been done for the time being because yes, IBC came in. IBC required very trustworthy valuations, which were perhaps not available based on the regulator's feedback. They activated Section 247, got IBC to refer to the registered valuer framework under Companies Act as well, and also made changes slowly in CB regulations so that all companies, whether they are listed or unlisted, are required to follow CB regulations, required to follow the new procedure of valuations as specified under Section 247 of the Companies Act. Persons in employment cannot be registered valuers. They cannot be registered valuers. We have already discussed about the Companies Act parts, wherein the opportunities that are available to registered valuers under present framework include all these. Then it also includes Insolvency and Bankruptcy Code. There it talks about how valuation is compulsory under CIRP liquidation, and as well as individual valuation for assets of individual guarantors to corporate guarantors to individuals who were guarantors to a corporate debtor, to a loan taken by corporate debtor to be specific. And then of course you have CB regulations, which we have already discussed. The Companies Act, the total number of active companies, when I checked online, comes to about 12.6 lakh companies as in September 2020. As compared to this number, again, this is one opportunity where every company might need some or the other valuation requirement. The number of public announcements. So we look at the scope of work for under IBC. We have about 4,464 CRP cases that have entered the CRP process, about 1,281 liquidation processes. Separately, voluntary liquidation applications are about 952, and individual bankruptcy for corporate guarantors are about 132 cases which are filed with the NCLT. And if you notice, this is a substantial number because all CIRP cases, most liquidation cases, and all voluntary liquidation cases do require evaluation, and it has a very strong impact on the overall process of IBC. So registered value is about 4,226 individuals as on date. We have this breakup available as on 31/3/2020, which includes a bulk of valuers as land and building valuers. Then we have plant and machinery valuers as 407 in number, and then they have securities of financial assets, which are about 1,522 in number. Registered valuers is one framework that is available in form of individuals as well as in the form of an entity. So what happens in an entity? One, you can have multiple people. You can make an entity out of different valuer partners coming together. The second part, which is also important, is how the valuations can be done under synergy, with complete synergy with the valuation, with the other asset classes. So indicative number of wealth tax valuers has been about 7,482, but here the shares and securities valuers were very less. It was only 132 pan-India. And this primarily might be because they were normally, all the sections, all the provisions within the Wealth Tax Act or within Income Tax Act have been modified to talk about how shares and securities should ideally be valued based on the feedback or based on the report from the chartered accountants or merchant bankers or registered valuers. So comparison, if you look at chartered accountants, we are a good number as compared to these numbers. So one can always make an early start by looking at these options available to you. This is the kind of geographical distribution of registered valuers, which is available in IBBI newsletter for the year ended 31/3/2021. And it seems that yes, many valuers in Tamil Nadu, many valuers in Maharashtra, many valuers in Delhi, and Delhi has the maximum number. Then we have a good number in West Bengal. So the idea is to understand that, okay, where do we have which valuers, and it is a very, very easy search. In case you want to look for a valuer in a particular area, you can simply punch in the email address and it should normally throw you an entry that you're looking forward to. Age-wise, now registered valuers age-wise heavily skewed towards the 30 to 40 bracket, and then yes, there are few people who are also part of 40 to 50 bracket, but mostly young population which is becoming registered valuers with IBBI, and substantial number of below 30 as well. So people who need to be registered valuers or SFA valuers, you need to understand that you have to have 3 years of experience as a 3 years of experience as a chartered accountant or 3 years of membership with ICAI or other professional bodies. That is the requirement. Steps to become a registered valuer. So you check your eligibility, and if you're a CA with 3 years post-qualification experience, most probably you're good to go. Attending 50 hours educational course with any IVO. There are about 16 RVOs as on date. You can select any of them. Maybe I would like to mention here and rather congratulate the committee of the RVO, ICA RVO, that they have managed in all this competition of 16 RVOs, they've managed to have 50% of their faculty. They have managed a good faculty. They have managed to have about 50% of the total securities of financial asset valuers in the country. And of course, they have to pass valuation examination. We will come to more details about the same. And then we need to apply for membership with RVO and IBA as a registered valuer. And this is what is required to be understood. This is how the valuation examination is structured. So most of what you will study is valuation application and case studies. And then, of course, you have to have a very, very practical insight, practice, keep practicing, and then you will perhaps be able to find out based on the practice that yes, the examination is a reasonably difficult level, and that's what I think you need to keep in mind when you're studying for it. So it's an objective type question, objective multiple choice question, the examination. There is a negative marking of 25% of the marks of the questions. In case it's a 1 mark question, 2 mark question, then 25% will become a lot less as compared to some other option. And of course, you need to secure 60% of the marks for passing. A specific candidate is awarded a certificate, and then of course that certificate is what that person shows when anyone asks for it. This is the kind of success rate people get when they give this examination. So first phase, second phase, and third phase. So these have been the changes in the valuation pattern or the examination pattern at IBBI, and it talks about March 2019. This 1 year, 4,496 attempts were made, And then, of course, 707 out of them were successful attempts, and that makes it a 15.73% case. Then, of course, there is a second phase when the examination was tightened, the syllabus was more adult, and therefore learning curves were implemented within the framework. This ratio dropped to 13.68%, and then in third phase, of course, it is about 9.8%. So this is the kind of passing percentage that people have when they give this examination. So we talked about the committee that we had discussed. It was set up on 30th August 2019, and it was to examine for regulation, development, and valuation records, and valuation professionals. The committee of experts has reported this study in a very, very good, very, very structured way. And yes, they have reported to the Government of India on 2nd April 2020, and the 2,500, almost 2,500 page report talks about how there is a volume 1 talking about executive summary, reports, and then draft bill, and then talking about volume 2, volume 3, and annexures and appendices that are attached to the report. So everything is available to everyone. This is all this is downloadable. You can have a read. I will suggest that if you don't want to read the whole document, do read pages 1 to 17. It will give you a good framework on where is this profession headed. It is a very, very well-made summary. It is a very, very concise and to the point document, which will help you understand more about this. So the draft valuer bill 2020, which has been, of course, put up, which is basically there, and which is what proposes a National Institute of Valuers. So it says that yes, IBBI will remain the regulator for Insolvency and Bankruptcy Board of India. It is continuing to have a name as Insolvency and Bankruptcy Board of India. So how can we kind of merge it into that institute? And then, of course, everyone understands that valuation is a very, very decentralized operation across the country, and having too much of a retail model or too much of a model where you have a regular interaction will be difficult. So Valuer Institute, VPOs and valuers to be regulated by NIV, promoting profession of valuation by enforcing standards and good conduct, protecting the interest of users of valuation services in India, multiple periods of entry in valuation profession, and then it is proposed to include all regulatory and non-regulatory valuations in the scope of valuations. So this is the list of acts where what has happened is that we see that most of the acts where valuation is required today, they seem to be here, and they seem to be here, and they seem to be, of course, a step towards integrating valuation profession and integrating it in such a manner that all the valuations that are required under any regulation in anywhere in India, they can all be covered under one valuer bill, administered, where the valuers are recognized, registered, tested, and they're made part of the framework that is proposed, and that is what is the draft valuer bill. Coming to the next part, that is, of course, we need to understand what kind of valuations are required here. A brief introduction to whatever is required. Under Banking Regulations Act, there are a few valuations which are required whenever the banks have a restructuring, because Banking Regulation Act also controls all the banks. It is the special act which deals with the format for valuations of banks. It talks about how the various assets and liabilities in a bank's balance sheet are valued. It talks about how the banks are required to be regulated, and wherever a special transaction happens, how the valuation will be done. Securities Contracts Regulations Act again talks about how the CB and how the other listed securities how they are regulated. Securities, the Wealth Tax Act again then talks about is the traditional way of valuing or registering valuers, and it is there since 1972. That's not there since independence. It is since 1972 that there is a concept of registering as a valuer with the income tax authorities, mainly with the principal commissioner or with the director general, and that's where the Wealth Tax Act talks about valuation. Income Tax Act. Now, Income Tax Act asks for valuation at multiple stages. Just a second, please. So Income Tax Act says that you need valuation for various purposes. What are those purposes? Mainly those are all about fair market value. You issue shares to somebody at a premium under 56(2)(7)(b). You're required to do a valuation in case you don't want to follow the fixed formula that has been prescribed under Section 11, Rule 11(UA) Part 2. You're doing a transfer of shares or transfer of some assets from one person to the other. You need a fair market value, again defined under Section 11(UA) Sub-Rule 1, and talks about how the various securities will be valued. It makes it clear that equity shares can be valued using a formula, and that is something that doesn't require a valuation report. But when you come to the valuation required under sub-rule 3, there it says that yes, for securities, shares and securities other than equity shares, we need a valuation report, and there it refers to both merchant banker and chartered accountants. Rule 11(UA) Part 2 only now mentions merchant bankers, and of course the word accountant has been removed from there. Securities contracts, then coming to SEBI Act. So in SEBI, of course, there might be, of course, all these provisions that we have read, there might be a requirement for evaluation there. And as we saw that SEBI mostly has registered valuers mentioned in the various provisions. And of course, that is what we talked about, we read about. IRDA has certain requirements under the Act. FEMA has, of course, the requirement mainly when you have money coming into the country for acquisition of shares or sale of shares, and the money going out of the country. That is when the RBI is concerned about the fact that the money that is coming in should not be less as compared to the value of the shares that are going out or that are being allotted to a foreign person. And similarly, when you're selling the shares, you should be selling them for a value which is less than the which is a value which is less than the value which is the fair value. So in that case, again, if it is less, then you're not permitted to take the shares by paying lesser money to the Indian buyers of those shares. Then you have the securitization and reconstruction of financial assets and enforcement of Security Interest Act, that's SIRFESI. SIRFESI currently talks about a valuation requirement whenever the banks are required to sell the assets as part of sell the assets which are where they are enforcing their security interest, and that is where the SIRFESI Act comes into picture, and the banks are then required, banks, NBFCs, other recognized financial institutions are then required to appoint a valuer. That valuer currently is needed to be on the board of the bank, is needed to be, approved by the board of the bank, and it has to be a wealth tax registered valuer, and that is where the SIRFESI valuers do the work. Then there's Prevention of Money Laundering Act, which requires some valuations. There are Then there are LLP Act. Again, there the valuation requirements are proposed to be changed so that registered value framework will be common there. Then the Companies Act 2013, Pension Fund Regulatory and Development Authority Act, Black Money Undisclosed Foreign Income and Assets and Imposition of Tax Act, then the IBC 2016. And then, of course, it talks about that wherever valuations arise from the needs of the market, they can also be specified, and it is being, of course, mentioned here that that is also part of the valuation scope of work, and that will be regulated as well. Section 48 of the proposed draft valuer bill talks about how there will be 4 classes of valuers. It talks about valuation entities, associate valuers, fellow valuers, and honorary valuers. So it says the valuer means a valuer is registered as such under section 40, and it says that it includes valuation entity and all these. And valuation entity means a person other than individual registered as a valuer. Then it says that the associate valuer, fellow valuer concept has been brought in. Why is this important? This is important because these 5 years will be counted from the date on which you have become a registered valuer under the new framework, or the date on which you have become the registered valuer with IBBI. So in case, say, somebody passed the examination, became a registered valuer with IBBI way back in 2018. So in that case, he will complete his 5 years and become a fellow registered valuer in 5 years from then. Okay, so he will be able to say that he is a fellow valuer earlier. That is the idea. So you have to complete either the National Valuation Program or the Graduate Valuation Program. You have to pass the valuation exam of relevant asset class, having experience of 5 years in rendering valuation services. Then pass the valuation exam for restrictive asset classes, having completed specified hours of training, that is 50 hours. The same one that is continuing these days has been, of course, reworded a little here. And of course, it talks about how the committee of experts recommends that admission to the National Valuation Program should be made through a centrally administered entry exam, and that's what it talks about. Internship, 1 year for National Valuation Program, and Graduate Valuation Program would include 6 months of project work in initial years. Now, National Valuation Program means a full-time 4-year program. That is what they have thought about. But there is a relaxation for chartered accountants, which is very, very easy. The chartered accountant completes 3 years since getting membership from ICAI, and post that the CA can then enroll himself for the 50-hour course, complete the course, give the examination, and he can become registered valuers. For the time being, the IBBI in its Committee of Experts report has communicated that for the time being, this can be a part-time profession, the valuation profession, and they might think about making this a full-time profession after 5 years, because they do want the quality of the valuations to be high. And one of the feedback that has come to the regulator is that because we do not have regular people who are practicing valuation 24/7, the quality of valuers who are there is maybe not up to the mark as per them. Graduate Valuation Program is a 2-year program, and then, of course, talks about all these subjects. Then we need to understand what it takes to be a registered valuer. So not only does it take ICA membership for being a valuer for SFA class. In case somebody wants to do a land and building valuation, yes, there are these options that you can qualify under these provisions and then move on to directly, giving your examinations. So how do you become a successful valuer? You keep your knowledge updated of various industries. You keep reading about things that are happening. Read, reread, and read again. International valuation standards, very important. International valuation standards or ICI valuation standard. They are almost the same. It doesn't matter which one you read, but you should read them. Learn about the process that you have to follow. Learn about the documentation that you need to do, and so on, and reread and read again your own reports and keep making improvements. So I always say that yes, when you read your own report and you have become perhaps wiser since the last time you read that report, in all occasions, because you might have learned something new, something interesting, something which is important, and then putting that into your reports is important. Use modern technology, focus on regulatory and long-term objectives and not on short-term money making. Keep sharing and learning with fellow valuers. Understand and state out the scope of work very carefully. Focus on finding the perfect value every time. Perfect value is what is required. Perfect value is what is the norm, what is underpricing, overpricing. Both are very, very dangerous. So looking at insolvency, in case you underprice an asset and say that, oh, the liquidation value or the fair value of this asset is less than what it actually is, in that case, it becomes very, very challenging for the people who are buying or who have interest in the business to generate a to and it becomes challenging for the RP, for everyone, because they want to then take the company at the lower value. So recently, when this Jet Airways, when this resolution plan was passed for Videocon, there was a comment from NCLT in the valuation, in the report, in the order, and that comment was that the value that the lenders are getting from the resolution applicant, these values seem to be very, very small, very, very close to the liquidation value. And that is why accurate valuation is very important. This number is something you can't escape from. You can't say, no, this is something that I just did arithmetically. No, you can't do that. You have to do it with diligence, based on standards and based on the idea that nobody should be caused harm because of the valuation report. And I will take an opportunity to share with all of you this one page that I had come across. And this is a very, very interesting page. Why? Because it talks about how the various issues that have happened, the IPOs that have happened, what was the subscription, what was the issue size, what was the then gain. And if you see that, yes, we have some cases where, yes, the gains have not been there, rather there have been losses for the applicants of various IPOs. But mostly you see, like 80% of the cases you see positiveness, primarily because one, there is COVID, and one, there is a surge in the market. The markets are really doing well. And secondly, perhaps about the idea that there is a gain on the current market price versus the price at which the allotment, the listing opened, and with respect to the issue price. And that's where we need to understand what this difference is. How do you minimize this difference? And the idea is that, yes, most book runners, when they issue a prospectus with the person who is acting on behalf of the company, they when they do this activity for the company, they have a responsibility. What is the responsibility? The responsibility is that they need to take care that when the issue price is higher and the actual price discovery is lower, it hurts their statistics, because this is one statistic that has appeared in bold in the top page of the in the prospectus that is advertised in the newspapers, and that is what one needs to see, that okay, how reputed are these merchant bankers, what is the quality of their what is the quality of their research, and their price that they suggest does become the market price, but then we need to understand how do they how is that computed, how is that worked out, how is that valued. That is where we need to understand how we can do that accurately. I will now move on to the next part. This is something that I want to share with you. Just a second. No issue. I'm just sharing another screen. Just give me a second. Just a second, please.
Ankit sir, hello.
Yeah, just a second. Just a second.
Okay sir. Okay sir.
So I'll just come to this part where I will talk about the draft valuer bill. I'm just trying to open that part and discuss that a little. Just give me a second. So while I open it, I would like to comment that this new framework is very, very important for everyone to understand. This 17-page report is very, very important for everyone to read. And this one covers up a lot about how historically we have come to the valuation profession where we are. And it also talks about an attempt in the past with respect to getting the valuation bill and getting all the valuers together again. And this is what it is attempting to do. And I think there is a lot of synergy in this action where one can have the land and building, plant machinery, and other valuers together. It also has a lot of application in the form of valuations required by auditors for the Ind AS purposes. And that's again very important, because when we talk about valuations for fair value, under Ind AS, we are also looking at a lot of risk there in any overstatement or understatement of fair values. And that needs a very, very strong verification from the audit committee. Normally, we find that yes, this is done through the internal valuation analysis team within the company. And but this does need a very, very strong process-oriented system. In the draft CARO report that has been released, which will be applicable with effect from, which will be now applicable with effect from financial year 21-22 onwards, there is a provision which says that, which requires the auditor to comment in the CARO on whether the revaluation of assets has been done, if any, has been done based on the report from a registered valuer under Companies Act. And that is a provision that needs more clarity. There are two views on that requirement. One view is that no, it is only for revaluation of assets. The other is that it is required for the valuation of assets on a fair value basis under Ind AS. And there is some confusion there which needs clarity. And I believe that will be coming through, because many entities who are all the listed entities which are now reporting under Ind AS, there is of course a duty for them to come out clean with the prices or with the values of fair value of assets which are there. This is the report that has been released for on 14th April 2020 specifically, and it has a very, very interesting message. And it says that the valuer is required to bring out a value which is even better than the market. So it puts up a lot of responsibility on valuers by saying that yes, you are responsible as professionals to do a better job than the market. Now, market in itself is a very, very strong mechanism to find prices, demand, supply, other factors. They're all consumed within that effort. And therefore, it becomes even more responsible for valuers to act diligently, to give out a value which makes more sense, do a very, very strong analysis. IBBI has come out with further regulations. They have come out with something called guidelines on caveats, limitations, and disclaimers. So another view on that from my side is that when you have caveats, limitations, and disclaimers, which kind of almost remove your responsibility from the valuation report, it is also not something that is usable in the courts, in the legal, in the jurisprudence, in the judicial sense. And therefore, it is important for us to understand how this part is the responsibility will be towards the valuer. Rule 8.2, then I can talk about that, of companies' registered values and valuation rules, also makes it clear that you can't now be not responsible for a valuation that you had taken up and where you had appointed experts from some other asset classes. And that is also something which is very, very important for all of us chartered accountants, because many times what happens is that we get a valuation assignment to value the shares of the company, and we find out, oh, there is this real estate asset, there is this plant and machinery asset in the company, which is not part of the going concern entity. And when we try and get that valued from an alternative source, maybe a land and building valuer or a plant and machinery valuer, we kind of think that, oh, this is not our responsibility. But the fact is that correct valuation from the expert that you're appointed is also your responsibility under Rule 8.2 of the registered valuers and valuation rules. Then framework wise, in the valuation report, there are layers of compliances required. One layer is Rule 8.3, which is directly required to be complied by the registered valuer who is doing the valuation work under Companies Act. And then you also have international valuation standards or ICAI valuation standards, which again dictate about or talk about what all is required to be mentioned in the report. Then we have an understanding that yes, there is a And there is, of course, the guidelines issued by IBBI, as I said, and these are the three main frameworks where the valuation is required. And then the statute is, of course, there. So in that case, IBBI, in case IBC says that, oh, the valuation for valuation under insolvency and bankruptcy code has to happen in this way, and this is the value, these are the importances of value, this is the definition of value, we need to comply with that. Many of us are still confused between what is the basis of value, what is the premise of value, what is the valuation approach, and what is the valuation method. These are all four different concepts. Valuation approaches are different, valuation methods can be many, valuation basis, valuation premise, they can be very, very different, and every different valuation premise or valuation basis can give very, very different values to the same asset. One example that I take for everyone's understanding is, let's say you have a plot of land in, say, a South Delhi colony here, and you say that, okay, I want to buy that plot of land, but yes, there's a building constructed on the same. Now, will you value that based on the prospective rental from that one-story house? No, because you have to go for highest and best use. But in case there is something in that property which avoids the user, the buyer of that property, not to utilize that property to the full potential, there, yes, it might be a requirement for you to value the property in its current use. So therefore, restrictions, legal restrictions, regulatory problems, the way the asset is seen by the market participants is very, very important for all of us to value any asset. And therefore, when we value an asset, we need to understand that we are not supposed to simply use the numbers given by the management. As per IVS, as per ICA valuation standards, as per the IBBI guidelines on CLDs, it is very, very clear that I cannot write in my report, now it is banned, it is against the regulations, against the rules. I cannot write that I have simply used the projections shared by the client. I have to talk about how I have corroborated those projections with reality, how I have myself tried and understood as a valuer on how those valuations, how those numbers are achievable. And then, of course, the comparison, the whole process of doing a comparable transactions method, finding incomparable, finding the other discount rates, other factors that affect valuation, doing sensitivity analysis, all these then become part of our valuation, our duty as a valuer. Coming to this part, which I wanted to show you, it talks about how we'll just come to the part which talks about how institutions, how this new framework is conceived, how this is going to improve the whole process. So one thing that I need to tell you is that this new framework under the draft valuer bill, here the committee, the governing body is proposed to be constituted of the consumers of valuation. So say RBI is one of the regulatory bodies where the RBI is supposed to consume valuations drafted by valuers for FEMA purposes. So then RBI becomes one of the parties, one of the members of the governing body. And similarly, then there is SEBI, there are a host of other similar bodies who will be part of the governing body. And that is important for all of us to understand, because that will require us, or the process that will be adopted within the governing council will be to give the maximum comfort, maximum value to the consumers of valuers. And of course, it should be reasonable. Then even the valuers, the committee which is proposed for the purpose of developing standards for valuation, that is also something that is constituted of various such representatives from all these consumer bodies. And this is of course a new way of looking at things, that yes, if the customer is happy, then he will also keep the vendors happy, and that is important. Then there are a host of disciplinary actions. The good part is that the draft valuer bill talks about how these punishments, these warnings, reprimands, cease and desist can only be issued by the National Institute of Valuers, which is proposed to be set up under this act. And it will say that this will say that how others are barred from raising any FIRs, raising any other issues against valuers. The only authority that is responsible to act against valuers will be this regulatory body. So internationally, we see most of the professions going through this phase, most of the professions having a system where they are deeply regulated, they are answerable to their consumers, they're answerable for what work they have done. And I anticipate the same here. And that focus will be felt for capital markets as well. The recent phenomena where there was this private placement done by PNB Housing Finance has come into light. There is a big argument between SEBI and PNB Housing Finance on what valuation should have been there, what valuation report should have been adopted. Now here there is some confusion perhaps in the regulations, where yes, a company having AOA versus a company not having a AOA, can they have different regulations affecting them? Maybe they should not have those different regulations affecting them. But the idea should be very, very clear that when you're doing the shares for a private placement under the private placement route, the law should bend towards protecting the existing shareholders. Because what are we doing effectively? We are bypassing the rights issue process and we are going to a private placement process. When we are bypassing the rights issue process, we are giving a skip to all the existing shareholders and going to somebody else to get further equity invested into the capital, into the company, or further capital inducted into the capital, into the company. And that is where we need to be careful. Yes, there might be a shift towards the idea that how do you protect the existing investors, existing shareholders from the dilution that might happen in the equity shares that they hold in case the shares are given away under private placement at a cheaper price as compared to what they were issued. Now, there is an argument there that, oh, the shareholders are part of the shareholders, they will of course vote. But at times, you don't have a vote bank or votes with individual retail investors coming along and speaking out. I'm not saying that the company is to blame for it, but what I'm trying to say is that there has to be a check and balance in the middle, in the process itself, rather than the shareholders saying, no, we are not interested in approving this private placement because it is too undervalued. Right? That is not something that I think is important there, and therefore that valuation mechanism is always important. And when you look at historical financials, you must look at normalizing the financials rather than taking the financials as they are. And in many situations, it might happen that the values are different when you normalize them. And that will have a big impact on the overall values that are going to various stakeholders, or the values that remain with various stakeholders. And that is what protection is all about. That is where valuers, chartered accountants come into place, where proper disclosure, proper information, timely disclosure, timely information, company's health, everything is clear, nothing is hidden from the eyes of the due diligent investor, the diligent investor, and who does his due diligence. He should be informed. He should know that, yes, this is what he is getting into. So with that, I will ask, maybe we can have some questions that have come in and take up some questions that might have come in from the public, from the participants.
Hello?
Yeah, you're audible, sir.
Sir, is your session concluded?
Yeah, we can take up some questions. That is what I was saying.
Should we take questions, sir, after something left, or should we take questions, sir?
We can take questions now.
Okay, sir. So, sir, one question. I would request Rakesh Agarwal, sir, for the sir some questions, sir.
Sure, sure. We are having two questions. One is, what are the factors to be considered while estimating the value of future profit? There are some situations which are unpredictable. Example, COVID-19. In such situation, how to estimate the future year profit?
So it was part of this exercise where one of the RBOs was trying to standardize the action which is required to be taken or the precautions that are required to be taken in case you're doing a valuation and you want to put in a COVID impact in it. Now, the first question is that what should be the importance of the valuation date? Say COVID impact came around around December 2019. That's when it first filtered in, and the reality of that in real sense came to us only by the time of February 2020 in most likeliness in most areas. And what do you do with that? So in case your valuation date is prior to December 2019, perhaps that on that date, you would not take any COVID factors into consideration because on that date, there was no COVID around. So that's one point. Now today, in case somebody tells me, okay, what should be the value of this company? I want you to factor in COVID. My first question is, what does the company do? Today, in case I see travel industry and a travel industry where the travel was deeply dependent on international travel, most people will agree with me that that is, still far away. There is still uncertainty over when that will resume to normal. When will the hotels that were reliant on international tourists come back to their legs, right? Today, we see that, okay, maybe, Leela in Hyderabad at one point in time was charging a room rent of maybe 30,000 rupees a room night in the peak season. Today, it is available for maybe 5,000, 6,000 rupees every night. So why is that? Because there is no demand for them, because the demand was actually coming in from international tourists. And they will continue to perhaps go through that phase. Similarly, you look at restaurants. Some restaurants are shut down. Almost first thing that happens when a lockdown happens, restaurants are shut down. Then they take their own time to come up, start becoming alive, start becoming active again. Then again, you see, on the weekends they're all filled up because people are now desperate to come out and go out and eat out. So in lockdown, everyone is afraid, but the moment lockdown finishes, all the roads to Manali are again jam-packed. So how do you gauge this? So it will always depend on the industry that you're talking about. One has to look at what has happened in the past. So luckily, unluckily, we have the track record of one phase, right? And everyone believed that no, the second phase was much more serious and people will not venture out. But the fact is that yes, we are still seeing people venturing out, people going back to normal duties. At least those who are fully vaccinated are taking the plunge and going forward and doing normal activities. So totally depends on the industry. Healthcare today, maybe people will say, oh, healthcare hospitals should be valued above the normal. But looking at a time scale, everything is based on a time scale. So in case there is an impact, then you first need to assess how long is this impact going to be for. So maybe somebody will say 6 months, somebody will say 1 year, somebody will say 2 years. So then what can you do? You can discount your incoming cash flows for the next 2 years and then say, okay, then the growth will start happening like it was supposed to happen for that company, for that industry without the COVID impact. The second part, which is important, is the cost of capital. Today, in COVID times, we feel that yes, the market has jumped up, and many people agree with the analyst in this idea that they have jumped up because the cost of capital has gone down, and the cost of capital has effectively gone down, and people don't have an alternative to invest. So at one point in time, people were investing in equity markets for a return of 18%. And that was their expectation, that annually I will have 18%, 16%, 15% return. Today, maybe they are investing investing even if they're expecting 12% return because they don't have anything or any alternative to invest in. And that is what also needs to be understood, that at one point in time, in some point in time, in case inflation increases, in case other factors around the globe with respect to the high liquidity that has been pumped in by the governments across the globe, once it goes away, what will happen there? And that is a factor that has to be taken care of in the discount rate, because in case your discount rate goes from 12% to 15%, certainly the valuations will come down.
Yeah, thank you. And another question is, can share valuation done for the purpose of SEBI loader or for other to be taken for Rule 11 UA, which is applicable for Section 56 of Income Tax Act 1961?
So 11 UA Part 2, 11 UA Sub Rule 2 talks about how a fresh issue of shares requires a valuation under Income Tax Act. And the idea behind that is compliance with Section 56(2)(7)(b). 56(2)(7)(b) says that in case you give shares at a premium to somebody from the company, you're taking money from that person who is investing in your company and you're giving him shares at a premium. It says in case that person is giving you premium which is over and above the fair value of your shares, then we want to tax this amount. That is the idea of 56(2)(7)(b). And that's where you need to compute the value. The limitation here is that the 11 UA Sub Rule 2 limits this valuation to a particular method called discounted cash flow method. And obviously, in normal circumstances, this will be the valuation method that you will be using for most valuations. But in many valuations, you also go to market forces. As I said, absolute value versus relative value. So in case the valuer who is doing the valuation under LODR rules is relying more on market forces because he sees that, okay, the information is available readily. I have ready comparables available. I can use that information to give a valuation estimate which is closer. So in that case, they go to the market value method or the market approach method, I should say, market approach, and that means comparable transaction method, comparable pricing, publicly traded method. So when you use these methods, you're going to market method, and then you're not using a discounted cash flow method per se to rely on your valuation. That is where the trouble comes. That then in that case, for the income tax purposes, you will have a DCF method, and for the LODR purposes, you will have a method which is using market approach. In normal senses, these two approaches should converge with each other, where these are checks and balances on each other. That okay, the market forces, whatever valuation they are giving, normally the discounted cash flow should also give the same value, and therefore there will not be very high amount of difference between these two methods. But in some occasions there might be a difference. In those occasions, accepting the same value per share that you have derived in LODR rules may not be possible because of this particular restriction on discounted cash flow method. And we are, I would rather share here that this fair market value concept under income tax is something which is litigated widely, and there are many scrutiny cases. So what happens usually is that the client has in its own projections, its own beliefs on, or in its own projections on earnings on which everyone is trusting. The investor is putting in money, the valuer is doing the valuation, the chartered accountant is also then going ahead with all those allotments. And what happens at some point in time in future is that after 3 years, your scrutiny gets selected. And once the scrutiny gets selected, the first thing income tax officer says is, I want to check your compliance with 56(7)(b). 56(2)(7)(b). I want you to give me the projections based on which you have done the valuation. Now, what he does at that point in time is, when you had predicted those results 3 years back, you did not know the actual results, what they're going to be. But now after 3 years, those actual results are there on the financial statements. So the income tax officer will see that, okay, this was what you projected, this is what is the actual. And mostly they come to the same conclusion that, whatever projections you had, they are not matching with whatever are the actuals, and therefore we are putting them in trash. So even more important for your discounted cash flow methodology adopted for 11 UA purposes to be closer to your perceived reality. Of course, nobody can see the future. Nobody could see COVID coming in, and maybe somebody's projections that they made 2 years back have gone for a toss. But one can only try.
Yeah, thank you. Here, for practical purposes, you have just mentioned that the both valuation method will be slightly different for the both purposes. Am I right, sir?
Yeah. So one method doesn't give you the freedom. Income tax is not giving you the freedom to go to market approach. It says do discounted cash flow method. You can't change that.
Yeah. And one thing I would like to mention here that in the question asked, the question is related to section rule 11 UA sub rule 1.
11 US Subrule 1 talks about valuation of shares, which are valuation of shares and valuation of other items also, which are being transferred. That talks about 56 to 10. Now, that is the section which is used, and there the fair market value, if that is not used to transfer, then there is a tax implication under section 56. There it says that for equity shares, it gives out a formula. It says this is the formula that you have to use, and that is how you have to give a value. And once you use the formula, you don't have the liberty to go to DCF, market value, anything else. That formula is fixed for equity shares. Then below that, in sub rule 3, it talks about how the chartered accountant or a merchant banker can give the value of shares or securities other than equity shares. There, yes, you can do any valuation methodology, where there it does not particularly say that you have to do this method or you have to follow this method. It says that any report on fair market value computed by a chartered accountant or a merchant banker, but that is applicable only for a non-equity share.
Okay, right. Thank you.
Any more questions, sir?
No,
Okay, sir.
No.
Okay. So, sir, quickly, I just take some of the questions, sir. So it's from Priyanka Mehta from Chennai. Capital markets are highly exposed to sentiments, rumors, and different timing for the access of information. In this context, how do we value shares in capital market? Also, a company may be valued today based on parameters available today, but capital market are volatile. So how we value such shares with a factor of timing difference?
My answer to that is that yes, we are all in an unpredicted, unforeseen world. We can have, uncertainties in future. But yes, everyone tries. What are the basis of trying to project the future? One expects that, okay, what is going to be the growth in the country? What is going to be the growth in the industry? What is going to be the growth in this company? What is the management capability? What is the management plan with respect to expansion? What are the management plans with respect to expansion of their marketing facilities, expansion of their customer base? What are the possibilities for the growth of this company? Do I discount the future growth because of some change that is coming in? So if you look at Michael Porter's 5 forces model, you have to analyze those forces when you're analyzing the company. You have to talk about what are the threat from substitutes. Today, all the automobile companies who are manufacturing petrol or diesel run companies are facing this threat that whatever substitute comes in the form of an EV, which is giving me the same value at a fraction of the cost, or other additional values in the sense of no noise, in the sense of maybe easier maintenance, where I only have a battery to charge in the night and I'm good for the entire day. I can drive around my car. I have no restrictions with respect to the performance of the car, the speed of the car, the functioning of the car, the comfort in the car, and that is a big challenge. Then you can always have your strength against your customers, your strength to negotiate with your suppliers, your strength to with respect to competition between the market players. How competitive are they? Will they allow you to have a supernormal profit for a long time? How easy is it to enter into your industry? All these are forces that you have to analyze and try to predict what will happen to the company. That is what valuers are doing. As Professor Damodaran said in one of the sessions that I attended of his, valuation is not about running a model on some projections that are given to you. Valuation is about understanding if those projections reflect the future correctly or not.
Thank you, sir. Sir, one query from Shaharaj Kishore Prasad from Ranchi. What are the opportunity to evaluate capital markets?
So as I said, opportunities are multiple. One can do a lot of research independently. One can do research for brokerage houses. One can do research as part of the valuation analysis team within the brokerage houses. There is then opportunity for one to do valuation analysis and then work for international investment organizations. They have offices in India where they are collecting all this information, doing all this analysis work on foreign investment opportunities, and then taking investment decisions based on that. So there are a lot of opportunities in employment, in profession, and so on. I've already shared a list of CB regulations which require independent values to be deployed. That's a big opportunity. So either you can work independently, practice as a valuation professional, you can work with a valuation professional entity. There are about 43 now in the country which are working almost about half of these are working in all asset classes. Then you can work for brokerage houses which are analyzing listed securities on a day-to-day basis. That's my input.
Thank you, sir. Sir, from Reshma Mittal from Ghaziabad, whether valuation of shares to be issued on premium can be carried out by registered valuer?
No, 11UA subrule 2 only allows merchant bankers to do that valuation. So yes, a CA can always work with merchant banker, but it has to be from the merchant banker.
Sir, then from Shilpa Sudhesh Shetty from Thane, how do we look for opportunity in SEBI after clearing valuation exam securities?
One needs to talk about what they know. One needs to have webinars, talk about what they understand, what they know about all the valuations that they have done in the past, how they have done good work. And I think opportunities come when people know that you can do good work for them.
Sir, then from Balaji KS from Tiruchirappalli, for opportunities in valuation capital market and such assignment, can fellow member of the ICI be given the assignment, or should he acquire the membership of the Institute of Valuers?
So institute, when we talk about registered valuers has about 16 RVOs. One of them is ICA RVO also. And there is no restriction from the institute that you cannot be a member of some other RVO also. So you can be a member of ICAI, you can be a member of IOV or PVAI or CEV RVO, any of the RVOs. Yes, it's good to know that yes, more than 50% of securities of financial assets valuers are registered with ICAI RVO. They have a very, very good faculty, very, very strong faculty. And I myself have done my valuation course from there. It is a sought after RVO. One can do it from there or other places. There is no restriction. Today, it's all about multifaceted profession. So you can be a chartered accountant, you can be an independent director, you can be an insolvency professional, you can be a registered valuer. But yes, you shouldn't be the auditor for the same company that you're doing valuation for or you're doing insolvency for. You have to maintain that arm's length, that if you're playing one role, if you're wearing one hat, you should not be wearing some other hat for the same client or where you have a conflict of interest. Rest, you are allowed to do multiple professions for the time being till the time some restriction comes in. The draft valuer bill, as I told you, has a provision, has an anticipation, has a target that because they want valuers to be full-time professionals, they are talking about how maybe after 4 years from today, from whenever the valuer bill becomes a reality, becomes an act, they propose to tighten the rules and make valuers more full-time valuers than part-time valuers. But in the part-time, in the meantime, you can enjoy.
Yeah, thank you, sir. Thank you. Then from Kumara Sen from Sivakasi, which method is best suited for valuation purpose for all types of companies, irrespective of different of its nature of business?
Very difficult to say. As I said, you need to understand the difference between valuation premise, valuation basis, and valuation method. Valuation method talks about using economic principles, 3 different economic principles. One can use economic principle of price equilibrium. In that case, one will be following market approach. So in case you feel the market participants in this case will see how much is this company going to do as compared to its peers, and then come at a value, then you're doing a valuation under market approach. In case you say, no, anticipation of benefits is what I will rule by. Oh, I am buying a commercial property. I want to understand how much is the capitalization rate at which this property is coming to me. What is the rent that I'm going to earn? What is the value I'm going to pay today? If that is your market participants criteria for commercial property, you can't change that. Similarly, for companies, You will have different approaches based on the industry, based on how the company is doing at present. Wherever DCF is feasible, wherever it is feasible for you to anticipate the future benefits very clearly, there, yes, that is the most used method. Wherever that is not feasible, market approach becomes an alternative. In some occasions, the companies can't use market approach because there is no comparable. How will you find a comparable for a company which is into something which is totally new, where there is no listed entity? How do you do that valuation and the market approach? So it will always vary based on the companies. But yes, the first preference might be DCF, the first preference might be market approach. Totally depends on cost approach is, of course, normally the last approach that is followed, and only followed wherever there are certain exceptions with respect to going concern anticipation with respect to that company.
Thank you, sir. So then from Vicky Kapoor, Mohali, at time of issue of equity share at premium, whether getting valuation after startup registration is favorable or without getting it?
If you get a valuation after startup registration, you don't need if you are startup registered, and startup registered with the income tax authorities, you don't need to get a valuation done, because in that case you fall under an exempted category, so the tax is not payable by you.
So then from Sumit Varudkar, Nagpur, can SEBI ICDR norms for preferential issue of equity share override article of association requiring independent valuation report? Question is from the perspective of PNB Housing or LIC Housing, which is new in this day.
I talked about it, and I talked about how this is a conflict, how there is a confusion between two rules. The AOA provides for something, the Companies Act provides for something, ICDR talks about something else. My view is very clear that in case the minority shareholders are disadvantaged by any valuation mechanism, then the SEBI is the protector of all those minority shareholders, and it has a duty to come forward and say that no, the minority shareholders should have got better value from the private placement issue and not the lesser issue. My thought process has always been that the one coming in from the outside through the private placement route may pay more but should not pay less, because then the existing shareholders are disadvantaged.
So then from Sanjeev Pandit, Mumbai, when a large percentage of startup fail ultimately, how do you justify the projection adopted in failed startup if question in future?
So the startup world behaves or acts in a very different manner. It is not about DCF, it is not about market approach. It is more about trusting a particular team, trusting a particular person that he can do something magical. He can create something which is not there. We have been witness to many such transactions where there is nothing even on paper, something that is only in the mind, not even a brand which is not even known by, 5 people. And 2 people come across the table. One says, I have the ability to create this brand. The other says, I have money. And they come into a partnership where the person who is able to create that brand, who can build that brand, takes as much as 70% of the total equity of the company without putting in any money, and the other person puts in all the money. So what do you call this? This is all about partnerships. This is all about how partnerships work. Somebody can bring something to the table, somebody can bring something else. And that is what happens in a VC transaction, in a PE transaction, that there is a team which says, we don't have money, but we have an idea, we have the skills, we have the zeal to work day and night and create something out of nothing, something that is not here. And the other person says, oh, I am interested because I know that I trust you guys. I want to put in money behind you. I wanted to create this business, make it bigger, bigger, bigger. And someday either somebody like Walmart or Tata's will buy that business and we will make money out of it, or maybe we will issue an IPO and liquidate our stock in the market. So that is the whole idea. That is an economic sense. So many companies in America and India today are now like that yes, they have created something, but yes, the problem is that these are one in maybe 20, 25, 30 companies that makes it. There are many others which succumb where the money is lost, and that's a risk that all these investors are willing to take.
So then actually 2 questions I'm just combining from Divya Jain, Chennai. Who shall be a valuer for private placement and preferential allotment as per SEBI law? First, then who shall be a valuer for ESOP under Income Tax Act and FEMA?
So a preferential issue, it is required to be registered valuers, and for the second is ESOPs, right? So sweat equity, yes, a chartered accountant is still taken care of in the sweat equity system, and wherever the sweat equity is issued by an unlisted company, there again the requirement, in my opinion, is something where the sweat equity can be valued by a registered valuer again, because there again the sweat equity rules come into play, the issue of shares and debenture rules. Yeah.
So then from Om Prakash Thaniye, is a valuation report required for sale of equity share of private limited company having paid up capital of rupees 1 crore?
So the company is allotting new shares. The question is not very clear. When it says sale of shares, then maybe be talking about a third party share sale, where one party, A shareholder is selling the shares to B shareholder. In that case, the fair market value concept will come into play, and the value at which these shares are transacted have to be more than the value which is derived under the formula specified in 11 UA rule, sub rule 1.
Sir, one member is appreciating nice deliberation. Manoj Agarwal from Prayagraj.
Thank you, Manoj.
Then one question from Vishnu Babu Agarwal, Agra. How we value of share of private limited company in which only land is exit?
Only land exists. So in case there is a private limited company where there is only land, if you're talking about a valuation under income tax, the income tax is now very clear that the price per share has to be adjusted for the circle rate of the property, and that is the minimum price at which the shares of the company can be transferred by the shareholders without attracting any further tax under Section 56 or under 53 CA, I believe, yeah, AC or CA. And the other part is, of course, Companies Act. Companies Act, again, in case somebody is transferring shares to somebody else and it's a closely held company, Companies Act does not specifically require a valuation to be done. It allows freedom in sense that anyone can buy, anyone can share. I don't think there is any restriction there. It is only for the purpose of income tax that this valuation will be required.
Ankitji, here I would add one more question. For that purpose, any valuation report is required to be sought from the valuer?
With respect to the valuation for the land?
Yeah, no valuation for the land, valuation for the share of private limited company, like which Vishnu Babu has just mentioned.
So if a company has a land holding or a land or building holding, what is required is the method of the circle rate computation at some point in time might be required to be explained to the income tax officer in case he comes back and wants to check the value taken by you. And that computation should be available. There is nothing legally written that you need a report, but some people feel that, okay, let's keep a report with us so that it will be easier for us to manage this kind of an assessment if it comes up. At that point in time, maybe there is some confusion, maybe we don't have a certified copy. Because the normal way I or maybe other people in the industry look for circle rates is that we just call up somebody who does work at the registrar's office and ask him that aajkal kya circle rate chal raha hai. If that person is good enough, educated enough, he will share some notifications with us and we will compute it based on those notifications. This is the method I believe is followed all over India.
Thank you, sir. Then from sir, one appreciation, Vinod Kumar Chhavar from Muzaffarnagar. Wonderful session. Congratulations, Anuj Goel sir and managing committee of Agra branch for organizing such a wonderful virtual CPE, and thanks to the speaker. Yeah. Then sir, plenty of more questions, sir. One more from Jaipur, Nikhil Gupta ji. In how many years the act is prevailing? NIV.
See, the bill is there. There is a discussion that has happened. Unfortunately, there was a rumor that would be presented in the winter session. That did not happen. I was watching it closely, so I'm expecting it to happen sooner or the later. I don't think it is on the back burner. I think this government is eager to pass this and get this through. This is what was the communication that came through when it was actively being discussed. Of course, COVID, all the other issues keep dragging this further. Let's hope that the current session might have some light ahead on this new bill.
Surely, sir. So then I would take one last question from Ram Samaria Ji Mathura. Sir, if asset is revalued and accordingly incorporated balance sheet and balance sheet revised, how to analyze such revaluation cases and what technical ratio to be applied to see real-time growth?
So, see, the whole concept of revaluation, as it is also done in Ind AS, is that how do you compare the financial statements of a company which started operations 30 years back as compared to a company which is, as new as maybe last year. The company which was just started last year will have a land worth 100 crores in its balance sheet, whereas the other one, which is maintaining records on historical basis, 30 years back might have the same 100 crore land or equivalent land worth 200 rupees standing in its balance sheet. So how do you compare them then? How do banks compare them to give loans? How do investors compare them? And that is where the whole idea comes in, that fair value is good. Now the next question comes is, what if the fair value is inaccurate? So the whole idea is that you can't just bury a good idea into the ground, because there can be a mischief on that idea. Now the only thing I can say is that there can always be information available on what is the value of the asset that is reflecting in the financial statements. One can always do their own due diligence with respect to whether that value is realizable, feasible or not. And of course, there are all these checks and balances on the auditor, checks and balances on the directors, checks and balances on the company itself to disclose the value correctly and without any excesses. That is what we need to rely on at times, because if you look at financial statements at times, you may not even be able to get the breakup of all the land and building that the company owns. That breakup is only available to the auditor, and that's why the auditor needs to do their duty diligently, that they do not allow any fair value to creep in. We have come across certain such mischiefs as a valuer, where we have been asked to turn a blind eye on the income generating capability of an asset and give a fair value for the purposes of Ind AS balance sheet. And yes, we have refused. Others hopefully would have refused. So that is what we are betting on. So a valuer's report, even for an auditor, is not the complete thing that they can rely on and blindly then go ahead and complete the audit and say that okay, these fair values are accepted. It is important for even the auditor to read that valuation report, look at the caveats, look at the limitations that the valuer was going through when he completed that valuation report. And in case the valuer has said in his report that I did not consider income approach because the client said no to it, or the client said this is not part of your scope, that is where the auditor should also say that no, this is not right. You give me a report wherein all the three approaches are considered.
Thank you, sir. So plenty of appreciation is coming. It's a very wonderful session. Then thanks to all for organizing this VCM. So we are already way ahead of the time. So now I would request CA Deepika Mittal ma'am, Secretary Agra branch, to formally give a vote of thanks.
Thank you, sir. Respected CA Anil Goel ji, CCM and Chairman CCMIP ICAI, और हमारे आज के स्पीकर सीए अंकित गोयल जी, आज के मॉडरेटर सेक्रेटरी ऑफ CCMIP अमित अग्रवाल एंड कुणाल जी, पूरी मैनेजिंग कमेटी आगरा की, चेयरमैन, वाइस चेयरमैन, ट्रेजरर, सिकासा चेयरमैन, मैं सभी के बिहाफ से आगरा की तरफ से आप सब लोगों को बहुत बहुत थैंक यू कहना चाहती हूँ कि आपने आगरा को एक अपॉर्चुनिटी दी जिससे हमने ये जो VCM है उसको होस्ट किया, और अंकित जी ने बहुत सरल तरीके से, बढ़िया तरीके से इस पूरे VCM को अपने व्यूज़ रखे, अपने सारे क्वेश्चंस को बहुत अच्छी तरीके से लिया, और जितने लोगों ने भी यहाँ पार्टिसिपेट किया, सारे मेंबर्स को आगरा की तरफ से एक बार मैं पुनः धन्यवाद देना चाहती हूँ। थैंक यू ऑल ऑफ यू। नमस्कार।
Thank you, ma'am. Thank you all. Thank you all.
Thank you, everyone. It was a pleasure. Thank you, everyone.
Thank you, sir. Thank you, sir.